Okay, welcome everyone. Bitcoin is trading around $77,000 today as we record this, up around 28% since the $60,000 lows in early February. However, the bigger picture story for investors and financial advisors isn't the price. It's the fact that we've got a new digital assets framework here in Australia. The bill has been passed. To discuss the implications, today is my guest, Andrew McPhee. Andrew is the founder of Synergist, a firm built to bridge traditional finance and digital assets. Before Synergist, Andrew was leading financial services at SwiftX, and he also held roles at ANZ and Australia Post. He spent the last few years in the room with super funds, the big banks, and advisors trying to figure out what their crypto strategy actually looks like. This makes Andrew one of the few people who can credibly talk across all of those three different stakeholders. So, Andrew, welcome to the podcast.
Thanks, James. Pleasure to be here.
Yes, we've been chatting for feels like a couple of years now, and I've caught you around the crypto conferences and circuit there. So we've always got on quite well, I think, and you've brought a really interesting perspective that has sort of been missing in the crypto space, which is how are financial advisors bridging this crypto gap? As I'm sure you're going to talk about, there's been this inability or sense of an inability for financial advisors to actually discuss crypto with their clients. So could you give us just a quick insight in terms of what Synergist does and how you're trying to bridge that crypto services gap?
Yeah, great. So we make digital assets accessible to traditional financial service businesses, basically, because there's always, as you've said, there's always been barriers, a variety of barriers, which has made it hard for digital assets, crypto, to be consumed within a normal regulated financial services environment. And so that's where Synergist is focusing. I set Synergist up in 2017 after deciding I'd had my fix of corporate life. I think everyone's got a limit. I'd hit mine and so have been running it since 2017 and progressively embracing digital assets and focusing on how do we help bridge that gap into financial services, because as you've said, well, no one's been successful in doing this properly, and most people who have looked at the gap have only had one side of the coin. They've either only had the financial services side or they've only had the crypto side. They haven't been able to bring the two together effectively. And that's really where I've been positioned Synergist.
And with this new bill that's been put forward or it's passed now, past the House, past the Senate, this Corporations Amendment Act for Digital Assets, could you give us just a high-level overview of what this bill is and sort of what is the significance in the Australian marketplace?
Yeah, sure. So yeah, it's in law, right? We finally got there. It's a digital asset framework, which is an amendment to the Corporations Act. And as you say, it got passed. So there's two key components to it. There's a digital asset platform, a license, so you can come in and so it can regulate or bring within the regulatory perimeter exchanges, crypto exchanges, brokers, custodians, etc., which is very helpful. And then the second one is then sort of for more the players who are operating that real world asset space around tokenizing assets and again bringing them within that regulatory perimeter. So the benefit of that is that the financial services ecosystem can then start engaging with this asset class with a lot more certainty, because there's a law that actually says what is allowed to happen and not allowed to happen. And that's not just about their behavior, but it gives them more confidence about who they're interacting with.
And so before this bill got passed, it wasn't necessarily illegal for advisors to engage with digital assets per se, but there was kind of an absence of regulation or clarity stipulating what services are categorized as financial products and financial services. There's just this weird regulatory gray zone. Is that sort of broadly correct, or how do you interpret this change?
Well, first of all, I guess there are a bunch of barriers, and the first one is understanding, is knowledge. So those barriers have always been existing on the advisor side, coupled with a lack of motivation around really needing to push it as well. And so we can unpick that in a little bit more detail later in the chat, I'm sure we will. But this bill, what it will change is for the average investor, I don't think it's going to change really anything, because most of the players, the reputable players, the larger players in the Australian digital asset ecosystem have been self-regulating for years and already are operating at that or close to that level of standard. So I don't think that the experience of the average consumer or investor is going to change that much. It's more about how those businesses in the digital asset ecosystem, how they can interact with more traditional financial services organizations and reflect the mainstreaming of this asset class.
So let's double click on the point that you just raised with regards to maybe financial advisors haven't been incentivized or motivated. I still speak to some financial advisors today that don't really care too much for digital assets. Why do you think that is the case? So obviously, that's not all financial advisors. Some of them are very interested in digital assets. But why do you think still a large portion of financial advisors have yet to get in or show that motivation?
I don't think there's been a burning platform for them to do the change. And most people avoid change unless they have to. It's human nature. And I think if you look at the advised client industry and you look at the average age of the advised clients and the average age of the financial advisors as well, and we're just dealing with averages here, and there's always outliers, but there's a lot of financial planners. In fact, I'd say at least half of the financial planners out there, they're in their 50s or 60s even. They've had their client base pretty locked in with them for decades, who are also in that same age group, if not a bit older. And they're not asking for digital assets, really. Or if they are, they're just like, should I do this? Shouldn't I? They're not really pushing that hard. So for a lot of financial planners, there's just no burning platform for them to look at it up until now. And then, so you couple that then with the resistance of the licensees who don't really understand the asset class in a lot of ways and probably have got lived experience of decades of seeing these new the latest FOMO product class coming out. Often they don't end so well. And so the licensees are understandably, taking a fiduciary and conservative approach to the asset. And so they're not rushing into it as well, right? That leads to the whole ecosystem not evolving. So insurance won't cover it because there's no demand for it yet, or there's not enough demand for it yet. The guardrails haven't been built for this to be consumed as an asset. So I think that's probably, it's a stereotype, but in the advice industry, that's probably a large part of it. There just hasn't been that challenge up until now. However, and also I should say that the advice industry is also grappling with their own challenges. We've got Shield and First Guardian issues. We've got the compensation scheme of last resort. These are major issues in the industry that are taking a lot of their discretionary effort. And so every bit of time and attention that they spend on digital assets comes at an opportunity cost. So they need to be motivated. And that motivation hasn't really been prevalent. But I think that's changing now. And so I don't know if it's going to happen in the next 6 months, the next 12 months, the next 2 years. But within the next 2 years, I expect that we will see that mass adoption of digital assets through the financial planning channel.
Yeah, I think it was Independent Reserve Survey said 31% of Australians hold or have held digital assets at one point in time, and that's increasing. Is that the burning platform in terms of if you don't bring digital assets into the portfolio for your clients, those clients are just going to go elsewhere?
Well, again, put yourself in the shoes of the financial planner and say, well, what are they doing, right? And so if they've got a mature book and they're 5 years from retirement or something like that, what are they motivated by? Well, what they're motivated by are probably two key things. One, if they want to sell their book, they want it to be attractive to the next wave or the next evolution. And secondly, you've got the generational wealth transfer. So you've got the older clients who are wanting to bring or transfer either their wealth across the younger cohorts or even get them involved in some of their decision making around investments so that they can almost train them up in a way. And those younger cohorts are looking for that exposure. And that's often one of the first signs that, hey, we need to do something here. They're coming in saying, we want this, and they realize, I'm going to lose this client if I can't talk about this asset class. The next generation are not just going to lock in and stay with the same advisor. So they're probably two motivators that I see that older demographic of financial planners should be thinking about. Of course, not all planners are in that cohort. There's a lot of younger ones, younger client base as well. They're probably already talking about digital assets. Their customers, their clients are much more likely to hold it already. So their challenge is slightly different. It's more understanding, what can I say? What can't I say? How much support can I give them? What falls within an advice conversation and not?
Yeah, gotcha. Yeah, it's a great point on the generational wealth transfer. I think it was JB Ware put out a study. It was anywhere from 3 to 5 trillion over the next 2 decades is going to transfer from boomers to the millennial generation and Gen Z. So absolutely critical to be aligned, I suppose, with where people want to invest their capital. In terms of the conversations you've had with advisors so far, what would you say are the biggest misconceptions advisors have about digital assets?
Probably that they see it as a technical conversation rather than a behavioral or a structural challenge. The clients are coming to them and asking, should I buy Bitcoin? One of my friends bought a whole bunch of Solana and he says it's going to run in the next 6 months. Should I get in? Or even I want to put 200K into this token or whatever it might be, right? And so that's probably the misconception, is that they need to kind of answer that question specifically, whereas they don't. They don't need to be the experts. They shouldn't be the experts in digital assets. They should be treating it just like any other asset class or any other emerging asset class as far as they treat it. So it's a behavioral and a structural challenge that they've actually got, as opposed to a technical challenge. And the mistakes are that they tend to sort of look straight away into a product allocation. Oh, you should go and join, maybe I'll send them to James at BlockByte, or maybe I send them to SwiftX, or maybe I put them into an ETF. Whereas that's not the right approach. It's like any other asset class. You should be sitting back and first of all saying, well, what are you trying to achieve to your client? What's your intent? Is this a short-term speculation, or is this a long-term vision and belief that you have in this asset class that you want to get exposure to? And then what role should this play, therefore, within your broader portfolio? What allocation should we apply to this? And then talk about implementation risks and say, well, how much ownership and control do you want versus convenience and access? Because there's a trade-off depending upon how you access exposure to this asset class. And then you get into here are the pathways or the products that are suitable to you. And so that's probably one of the key challenges, is how can most advisors haven't spent the time to actually build out their own digital asset policy or framework for their practice. And that's exactly the space where Synergist is trying to support them on, saying that's what you need to do first. Understand what your position is, what you're comfortable with as a practice, what allocation range you're comfortable with for what type of clients. How do you determine what clients should be sitting in what allocation range? How do you bring that into your normal compliance and audit framework so that whatever you're doing is fiduciary and is defensible and importantly, consistent? Because the real risk here is not that you get them into the product. The real risk is that you avoid the conversation and they go somewhere else and they do it outside of the protections of an advised relationship and potentially get themselves in trouble.
Yeah, we've had a few clients that have come to us after having been scammed, just because they haven't had anybody to guide them through, and they've put money into either the token itself was an outright scam, or they've invested in an overseas exchange that's rug pulled them, 6 months down the line. So definitely value in having those advised relationships. In terms of, you touched on their advisors having that conversation first to make sure that the client goes to, let's say, the right platform, the right type of custody. For a financial advisor that hasn't really dug into crypto yet, what are you talking about in terms of types of custody and types of platform? What are the options out there? What are the differences?
Yeah, great. And this is where I guess the structural component really comes in. So you need to build, first of all, a foundation knowledge of the asset class before you can sort of go into this next level of detail. And so it's always about educating yourself on what are the foundations of the asset class. What is crypto? How does it work? What are the mechanics of it? So that you've got that understanding, so that you can explain it to your clients in a way that they can understand. It doesn't mean you're an expert, but you need to have a base understanding. Then you can start getting into the selecting the right pathways for them. And one of them is ownership or access. How do you get access to that? So when you get to that level, it's really about, again, asking your client the right questions. So do you value control over convenience? Where do you sit on that spectrum? Do you trust yourself that you can control security, or would you rather delegate the security to a professional? And again, based on their intent around why they're interested. Is it about sovereignty? Traditionally, Bitcoin's been about sovereignty. It's not your tokens, not your Bitcoin kind of thing. This money I can hold outside of the financial or a regulated or a government controlled ecosystem, and it's transportable and immutable. So that, for a lot of traditional investors or holders, has been a core part of the appeal to them around storing it themselves and having control, independent authority over their wealth. So is that important to you or not? Because there's kind of a spectrum, and I look at it as a spectrum anyway. At one end, you've got self-custody, which is where you've got your own hard wallet, you own it. The crypto is sitting on that, you're in control of it, you own it, and you're the security manager for that as well, right? And that accountability and responsibility. Now, that's suitable to some people, but not everyone. And then you can sort of move into more an exchange type relationship where it's more like internet share trading, where you've got an account online and you're executing through an exchange and they're custodying it for you. And that's great for some people as well. Then you move into more an ETF where you're saying, well, this is just accessing through traditional financial rails. It's a regulated product. It's easier to consume. It's consumable into, you can see it on a platform with a financial planner. They can see it automatically, and that's great there. Or you can go into a managed fund where you've got a professional managing this portfolio for you, making investment decisions at the far end, and they're trying to outperform that index or get you certain exposure profile for your investment. Now, each of those things have got their benefits, but they've each got their compromises. At this end of the spectrum, you're compromising control and ownership because you don't actually own the crypto, the Bitcoin, for example, in a managed fund or an ETF. You don't have beneficial ownership. You've got ownership in shares in a unit trust, but you don't own the Bitcoin. Or down at this end, you're taking full responsibility for security. You get full responsibility for the technical interactions with your wallet. And if you lose your keys, then you're never getting that back. And you're taking that risk on yourself there as well. So it really comes down to asking the right questions to your client, understanding what's suitable for that client. Then you've got the access point. And the fun decision then becomes, okay, now you know what the right access point is. Who's then the trusted party that you then say, for this type of exposure, I'll send you to the providers that I think are best.
Gotcha. Yeah, that makes sense. And in terms of, I suppose, traditional statements of advice and templates that financial advisors have, do you think those would be leverageable for digital assets, or do they need an entirely new framework to deal with this asset class?
It's a good question, and it'll probably come down to each practice. I mean, you've got a big variety between, the small independent one or two partner advisor, practices who are authorized reps under someone's license versus the big firms who have a lot more of their own capabilities and their own frameworks fully formed. So I think it's not necessarily, there might be a variety. However, I always say that digital assets should just be another asset class sitting on the shelf alongside your shares or your managed funds or your property, real estate investment trusts. It's just another asset class that an advisor should be able to use to achieve their clients' goals. And so therefore, it should also be aligned to the way they approach other asset classes. So they need to know what their policy is on it, who they think it's suitable for, what sort of exposure range it's suitable for. And then it needs to be embedded. There needs to be a governed, auditable trail of decisions that you can draw back and reference on the client files so that it's defensible, but also so it's consistent. It's got to be consistently applied. Now, if you can do all that, that some parties might be able to do that in-house. Synergist, I've built an operating system that actually there are licensees who don't have that capability. They can use the Synergist operating system where they put the client scenario into it. It guides them through a series of questions which will take into consideration their policy frameworks, what decisions they've made as a licensee or a practice about how they want to see digital assets. It applies that to the model and then gates each client scenario out to a predetermined outcome, and it documents it all. So there's an auditable, documented process with outcomes that are set and predetermined. And that's good for practices who don't want to be running the administration of it, just thinking they're going to put 2% or 4% of their clients' portfolio into it. They don't want to be managing relationships with, looking out, should I be putting them into Coinbase or SwiftX or Binance? It takes care of all of that. So it depends on who you are, really.
And just switching gears briefly, in terms of the big banks and super funds, I know you've been speaking with some of the super funds as well recently. So let's start with banks first. There's been a bit of a culture within the big banks, specifically Big Four, to block deposits to digital asset providers.
Yep.
And some investors have actually missed out on gains. I dare say some people have missed out on losing capital as well at times. But why do you think the big banks have made it quite difficult these days to deposit your money on a crypto exchange?
So look, it's not accidental. It's a deliberate and rational response to the regulatory pressure that the banks are faced with, right? It just has unintended consequences. So banks, I've spent many years in banks over my career, they are operating within a tight regulatory environment where they've got AML and CTF obligations, board risks, and they've got reputational risk frameworks that they need to adhere to. And so you mentioned earlier that there are a lot of crypto scams and a lot of crypto fraud and a lot of risks out there, and it's still to this day not going away. So it is therefore something that does have a bit of a flashing red light on it if you're a bank. And where they, I think, failed a lot of their customers who are investing in crypto is they haven't put the work in to move beyond just de-risking the entire sector and actually applying more targeted and individual assessments or decisions around access. It's not that they're anti-crypto, it's just that their risk managers and the regulations haven't caught up with them yet. So I think that I see it probably that way. There's certainly a lot more that they need to be doing, but they don't have the information, they don't have the regulatory certainty, and they therefore just do blanket de-risking by blocking it all. And they've got to know that that's a problem as well. I mean, even Austrac calls that out themselves and says blanket banning an entire sector actually creates systemic risk because it drives legitimate behavior off grid, basically, and to find unregulated and alternate paths to the market outside of the traditional banking system. So I think that that's where they've failed. They haven't done the work to be able to move from just a generic system level approach to an individual approach, and that has to change.
Are you having any of those conversations currently with any of the big banks?
I'm not with the big banks, but I'm keen to. Coming from big banks, one of the things is where banks have been so far is with crypto is they've looked at it blockchain as settlement rails. They've looked at crypto from an innovation point of view, but these are sitting within the innovation teams. They're not getting into the risk teams. They're not getting into the product teams. They're not getting across into the areas where the change is going to manifest. And I think that that's really what needs to change. And they probably haven't had a pathway that guide them there. You know, the approach that I take is I start with risk. And I say, let's understand what the risks are. Even when I'm working in with a licensee or an accountancy firm, I say, okay, we're going to start off by talking about the risks, understanding what those risks are, and then letting you set your tolerances around those risks. Anyone in financial services, ultimately, their business is driven by the risk return continuum, right? So where do you sit on that risk return? You know you can't make a return without taking some sort of risk. Where's your appetite at the moment on these different variables? But let me explain what the risks are. So usually, once you understand what those risks are, you then can have an informed discussion with the right people in the room about where their appetite sits, and then you can capture that and document that. That then gives them that digital asset policy framework where they can say, all right, whatever we do, it needs to align to this. And that enables them to actually then build a structure around it, train their staff up around it, and actually start rolling it out across their business. As they do that, they learn more. Well, you just adjust those risk settings in that policy framework, and that's how you grow and evolve.
One of the obvious risks is that if people do deposit with a crypto platform and they transfer funds out of that platform, they think, to a separate investment scheme because they can earn interest. A lot of the times those platforms, as I mentioned, based overseas, and people can have complete loss of funds. Who do you complain to? You complain to your bank for facilitating the transaction. I do think if there are any banking executives listening to this, you can whitelist specific platforms that are reputable, have been in the industry for years, and have demonstrated good behavior and full AML CTF measures. I think the other thing is that it's going to be critically important, I think, over the next 5-10 years. If I was a Big Four bank CEO today, and I'm looking at the reports Visa are putting out, that in 2025, there was $28 trillion of real economic transaction value that happened on top of stablecoin networks. If you're a bank, and I know they are looking at digital assets, but there's not only regulatory risk, but there's genuine competition risk of not moving into this space with some degree of haste is going to surely put some of the banks behind. And if you're one of the first movers of the Big Four, can you imagine how many of us digital asset investors, users would absolutely just jump onto that bank and ditch the one that is lagging?
So I think this is where the new laws that have just passed, where that will make a difference, because once you've got an AFSL and once you're operating within that regulatory perimeter, it's much easier to do exactly that, to whitelist. If you're an approved AFSL holder, then on what basis are you blocking a transfer? Explain yourself. Like, that's not a defensible position. But it's also a binary choice that they can make as well. Are you transferring to an AFSL holder, licensed business? Oh, you are. Well, that's approved then, So I think that we should see some movement with that. I think the broader question, though, is a really great one. It's very easy for banks to lose sight that they exist to service the customer and the customer's needs, and that customer needs evolve over time as technology evolves. And I've built my career around exactly that space, understanding evolving technologies and innovations, understanding how that can benefit customers, and then building those systems so we can bring those solutions to the market. The risk is that banks don't do that. Then they operate on a pretty big assumption that they're so big that they're too big to fail. But if I look at everything that's happening today with technology, look at what's happening with crypto in the US and other European jurisdictions and Asian jurisdictions, look at what's happening with AI. That's a really risky proposition to just rest on your laurels and to say, hey, look, we'll be fine. I think that a lot of business will shift to providers who are meeting their needs better. And the reality is, as you've said, roughly a third of Australians have crypto. And there are a lot of the younger, skewed more towards the younger demographic, the next wave of customers for the banks. So are they going to capture those customers? Well, they have still been getting it as a default, but that's going to change. People are paying with stable coins. You're getting, with the Clarity Act, hopefully passing in the States in the next couple of months. And even without that, you're still seeing in the States that integration of DeFi into traditional finance and a lot of traditional banking products moving onto digital rails. So if you're a bank and you're assuming that digital assets will move into traditional finance ecosystem and rails, and therefore you can gatekeep that access and control it, if that's your basic position, well, I'd say that's a risky position to sit on. I think that what we're seeing in reality in other jurisdictions is traditional banking moving into digital rails. And you've got the scale and you've got the ability to take that as a first mover. But if you don't, there'll be a myriad of other digital native companies offering those services, and they will take your market share over time.
Yeah, very well said. Just closing our interview podcast. What is your personal view in terms of investing in digital assets? Do you have a spray and pray approach, allocate across different assets, equal weighting? Are you a hardcore Bitcoin maxi and Bitcoin only? How do you think about investing in the digital asset space personally?
I'm all in on Fartcoin. No. This is not financial advice, all right? This is where I put that mandatory disclaimer in. Look, to be honest, it's one of those classic ones of do what I say, don't do what I do. I've certainly fallen into a lot of the behavioral finance biases and traps over the years. And I think, this is probably a good insight. I'll answer the question specifically. Something really interesting is that anyone who operates in this space in investing in financial planning, you understand how significant the behavioral elements of this are. You're coaching your clients and you're stopping them from making irrational decisions, emotional decisions, FOMO, whatever it might be. And so digital assets is no different. It just is that on steroids. It's accelerated because the volatility spikes are so much higher. And so that leads to FOMO type biases. Social media, it's been largely unregulated and you've got finfluencers out there. And so if you're watching finfluencers and they're talking to you about your diet or your fashion trends or exercise habits or something, and then something pops up about crypto, people just think that's legit and they'll just consume it in the same way. And that leads to herding biases. And then there's a range of other of these behavioral biases that we see in behavioral finance, which digital assets is just accentuated. There's same sort of things. So what do I do? Look, I've probably only been investing in digital assets for like 4 years or so, maybe a bit longer, 5 years probably. So it's my portfolio was pre-existing before then. It was heavy on property, as most people my generation. So there's a lot of property and it's diversified across Australian equities and US equities, more US than Australian. I did liquidate quite a bit of the Australian equities sort of position in order to create some liquidity to bring in some digital assets. And I see digital assets in two buckets. One is my investing. So that's long term, and that's typically your main big blue chip tokens, the layer one protocols, so Bitcoin, Ethereum, Solana, typically, and that's your long-term sort of holdings that are more like an investment. And then there's the more speculative, narrative-driven token, which I think is more like a trading type dynamic rather than investing. And so that's a different sleeve in my portfolio. I control that as much as I can and not get too excited by it and try and keep it contained. That's much more around, okay, well, are there particular narratives that I'm really enthusiastic about, like the overlap or the integration of AI and digital assets or decentralized finance as it emerges in the US and with the change of regulations here, or real world assets tokenization. So, there might be specific things there that I love the sound of, and I'm like, I want to get a bit of a thematic exposure to them.
And in terms of your overall view, I love macroeconomics, so I always like to ask these kind of questions, but do you have an overall view in terms of the geopolitical situation that we find ourselves in today, and what do you see happening over the next sort of 6 months to a couple of years down the line?
Geez, I wish I had that crystal ball handy.
Tell me, Andrew, tell me.
All right. So I think that I've kind of given up guessing over the last 6 months on that because I thought I had a pretty good handle on it. And then Trump came along and rational decision making and conventional wisdoms based on previous experiences has kind of gone out the window. But what I would say is that I look at it from a fundamentals and a narrative sort of thing. So with the narrative, yeah, you're looking at things like obviously what's happening in the Gulf at the moment with oil, looking at liquidity, looking at inflation and what that's likely to do, impact it's likely to have on liquidity, looking at policy and regulatory changes that are happening across the world, and looking at, all these different indicators at that narrative level. And look, I struggle to see anything that's negative towards crypto and Bitcoin as well specifically. So I think that all of these trends, and this is why I've focused on this exact space, is because I buy all that narrative and I go, look, I've been in this game for a long time, and it just seems that this is a wave of change, that there's an inevitability about the wave of change as a theme. And so I get really excited by that, and I've got to curb my enthusiasm. But that's different from the fundamentals. So the fundamentals, well, how many of these DeFi protocols are actually making money? Show me the revenue. Show me the user to uptake of these crypto tokens, the businesses, who's creating value and how is that value manifesting into actual commercial outcomes? Because that's the fundamentals. And now what happens is we're good at seeing the themes, but we tend to be pretty bad at getting the timings right. So, we think that something's going to take 12 months and it takes 2 weeks. We think that something's going to take 2 months and it takes 5 years, which is why I tend to sort of look more longer term, keep a more simple sort of exposure to the asset class, because I don't have time to manage it on a day-to-day basis at my trading. Ultimately, that's where you come back to is where are the fundamentals? And that's why I get really excited, because stable coins, the fundamentals have turned, right? As you mentioned it before, that's the first mass use case for crypto where it's actually replacing global payment rails. And we're talking proper money and real value that's being materialized. And then we start talking about decentralized finance, and we're starting to see some of these fundamental things shift with adoption, with change of regulations, tokenization. You can see that's going to be the next wave. How it manifests, how quickly it manifests, not sure, but it's certainly going to be, the technology is offering enough of an advantage over the current way of doing things that there feels like an inevitability that it's going to be taken up and adopted and switch into these digital rails at some point.
What would be thought you would like to leave with a financial advisor, or something that you would impart to a financial advisor who's considering digital assets for client portfolios?
Yeah, I would say you don't need to be a crypto expert. What you need to build a defensible position. So rather than thinking about, should I let these clients, should I put them into Bitcoin, or should I put them into Ethereum, or should I put them into this product or that product? Instead, invest the time in building a defensible position that's right for your practice. That then defines the stance that you can then take consistently to your clients. So to be able to do that, you need to be able to educate yourself. I've just launched Australia's first crypto or digital asset education courses for financial professionals, for advisors and accountants. And am I allowed to do a little plug here?
Absolutely. Please.
So the end of financial year discount, up until the end of financial year, there's a 50% discount on the bundle as well. So you can see them at my website, synergist.com.au. But education is part of that, is like I say, the first guardrail. Educate yourself. That then enables you to build a defensible position as a framework that's right for your business. Then you can apply it consistently and confidently out to your clients.
Great. And final note to investors, somebody who's looking to invest in the digital asset space.
If your advisor won't talk to you about crypto, find one that does.
Brutal. I love that, Andrew. And thanks so much for your time. Where can people find you and the work you're doing at Synergist?
So you can follow me on LinkedIn, is probably the best way to stay up to date with what I'm doing. I run a podcast as well, a Crypto for Advisors. So if you are a financial planner or an accountant, then that's kind of a good place to stay up to date with what's happening in this space. And as I said, I've just launched these CPD aligned courses and they're available through the website.
Fantastic. Thanks so much for your time, Andrew. And I'm sure I'll see you around the crypto investing circuit soon.
I look forward to it. Thanks for the opportunity.